Mark, I want to start with a question that is from our previous guest, Pooja Kumar over at TD Bank. She was saying that there's really nothing that payrolls or inflation could give us next week that would put this Fed cut in doubt in September. Do you agree with that?
I don't agree with that. I know that actually there are many people in markets who are in that camp. I would say it's the majority view. But I think there's still a risk of 50 basis points, and I still think there's a risk of nothing. I think the non-farm payrolls will probably be less of a reaction than CPI, because if it's strong, cynical people in the market will say, well, because it's the new BLS chief and they wanted strong numbers and therefore they've got strong numbers, they'll look through it. They'll know that the Fed reaction function is going to be dovish. So I think it'll need to be monster strong for that to have a big impact on yields. And that's why I think, in fact, there's an asymmetric reaction function from non-farm payrolls to see yields go lower, because if it's very disappointing data, despite the change in the BLS chief, well, that would be a real downside for yields and might see 50 basis points priced. And then the next one is CPI. I think if CPI comes very strong, for example, if you see headline CPI at 3.1% and core is also a little bit above expectations, then I think, you know what, suddenly people go, how can the Fed possibly cut? And it puts that 25 basis points in doubt. So, yeah, I still think that the Fed meeting is absolutely in play. I think that, you know, the natural language model on the Fed at Jackson Hole, and Powell's speech at Jackson Hole, suggested that it wasn't as dovish as originally interpreted. The fact that he was leaving it open, he was validating pricing for a 25 basis points cut, but he wasn't confirming it'll definitely happen. So it's all still in play for the data over the next couple of weeks.
Let me ask another similar question, Mark. Gilts have completely round-tripped at the long end. Massive rally yesterday. Is that crisis over?
Like, as we talked about yesterday, you know, this move was getting quite extreme, given that there was no fresh catalyst in the short term. And we talked about how it was probably going to burn out at some point soon. I don't think that the longer term crisis, no, has not gone away at all. I think the UK is in a tough spot around its economy and the fiscal situation. But that's a story that's going to play out over many, many months. So the longer term crisis, no, is not solved. But short term, it does look like it's going to be behind us. I think the next big catalyst for bond markets is probably from France.
Mark, I want to switch the focus to equities, and particularly the stock story over in China with the news today around some of the efforts by regulators there. Can they engineer a steady, a slow bull market for Chinese equities?
No, they can't. I don't think that's how it works. I think, you either kind of temporarily set it back and you kind of dash enthusiasm for a bit, and maybe you clean out some weak hands and you get a bit of retracement, but then it'll carry on again. I think it's very, very hard for policy makers to guide a smooth bull market. Either you've got animal spirits and people are excited and the market gets completely carried away, or those animal spirits are dashed and you get an overreaction to the downside. As you know, I'm structurally very bullish the China-Hong Kong story long term. But sure, we're due a pullback, and now you've got a reason from the government. I think this pullback can go further, but people will look to buy it, and validly so.